Let's consider a very simple case of domestic consumer optimism, and let's see how to analyze that in an aggregate demand, aggregate supply framework. Domestic consumer optimism. So let's follow the simple steps that we use to analyze everything in aggregate demand, aggregate supply. The first step is almost always draw your diagram. So I start with the long run aggregate supply curve. There it is. I then draw a big X. That is my short run aggregate supply curve, and that is my aggregate demand curve. This is the price level. This is real GDP. And initial equilibrium is where everything crosses. There's the price level and the initial full employment level of output, which is related to the natural rate of unemployment. This is where we start. So that's step one. If you don't remember what shifts all of these, I often will write those in sort of shorthand notation off to the side. All of these things are positive, and those two are negative. And this basically shifts due to price expectations or the expectations of the price level and is negative. So if this goes up, this thing shifts to the left. If any of these go up, this shifts to the right. If any of these go up, this shifts to the left. Those are the shorthand that I use. Since we generally are not going to move the long run aggregate supply, I won't put what's in there, but it is all fundamental real variables: land, labor, technology, and capital. Now, we started with a well-labeled graph. That's step one. Step two is to take your shock and translate it into one of the variables in the model. So, domestic consumer optimism. So consumer optimism in general is sort of a shorthand way of saying, hey, consumers are optimistic, they're going to consume more, and that should affect consumption pretty clearly. Now, I was explicit in stating it's domestic consumer optimism, because if you think about it for a moment, foreign consumer optimism would increase our net exports. So if foreigners are suddenly very optimistic and there's a consumption boom overseas, they'll demand more goods and services in general, which includes goods and services they buy from us in the United States, which means that would increase our net exports. Therefore, I was very explicit in saying domestic consumers are more optimistic. That is a sign, just for as a professor, to tell you increase consumption. Okay, so we're going to increase consumption. So step one is to draw a diagram. Step two is to take your shock and to translate it into one of these variables so you know which curve to move. Now, when I do my analysis, I like to take notes off here to the side. In the short run, we got an increase in consumption, and that increase in consumption generated an increase in aggregate demand. Right through here, aggregate demand increases. We now need to label this temporary result right here. Sorry. And price level increased a little bit. So in the short run, we saw an increase in the price level to P prime and an increase in real GDP to Y prime. Since this was the natural rate of unemployment, output boomed. We also know that while this went up, GDP grew, unemployment fell. As GDP expands, unemployment tends to fall. So we can also add down here a drop in unemployment, even though it's not explicitly on here. What happens in the long run to get us back to equilibrium? Well, even if you don't remember how everything works, this line is going to act as our anchor. So somehow everything has to fall back onto this line to end our analysis. You have one of two choices. You can either move this back, or you could move this curve back. which one would move in reality. After consumption boomed and aggregate demand increased, that put pressure throughout the entire economy and put upward pressure on price level. Notice I haven't moved this curve yet. So technically, everybody is still expecting the old price level. When we started in equilibrium, this was the price level, therefore that's the one everyone expected. Instead, the economy expanded, output grew, demand grew, and prices began to rise. So you would be kind of stupid to continue expecting this old price level after you know the economy's expanded and prices have gone up. Furthermore, in macroeconomics, we tend to assume in aggregate people behave in a fairly rational way. And so not only do they begin to expect that the price level is no longer going to be here, but is going to rise up to here, they actually begin to predict forward and say, hey, it's not only going to be here, it's actually going to rise further. All of that means that price expectations begin to rise. There is an expectation of a higher price level coming up in the future as individuals begin to negotiate prices with their employers, suppliers with their clients, and so on and so forth down the chain. That pushes up the input prices in all the goods and service industries in the economy and contracts the short run aggregate supply curve. Now, because this went up. So we were here, people expected this price, demand expanded, pushed prices up some, people begin to build that into their expectations, into their future contracts, which contracts supply and brings us back here. So we end at another price level that's up here, okay? And now output did what? It fell back to its old level. So in the long run, there were higher price expectations, and that decreased short-run aggregate supply. That decrease in short-run aggregate supply raised the price level further to P double prime, lowered output back to its full employment level, right? So output went out and came back down, and unemployment had to rise. When the economy expanded, unemployment fell, but now that it comes back to its long-run level, unemployment drops back down. So we have a pretty clear prediction of what happens initially and what happens over time as the economy works out the shock through its system.